So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to Daily Call. Today we're going to be talking about why are SPX and ES different prices. So if you are a trader and you start trading in the broad markets, you'll likely come across these two ticker symbols. SPX represents the S&P 500 index, and ES represents the E-mini futures, also commonly referred to as /ES when you're trading in your broker platform, but it represents the E-mini futures on the S&P 500 index. So many people get confused because they look at both of these and they think to themselves, okay, well, you have the S&P 500 index, SPX, and then you have the futures on the index. So why are there different prices? And more notably, why does the futures contract trade at a little bit of a discount, air fingers quotes, discount compared to the SPX contract itself? So here's what you have to understand. The SPX is an index. You can't actually trade it. There's no tradable security. Just like what we looked at yesterday with the VIX, where you can't actually trade VIX, you can only trade options on it. The same thing occurs with SPX. You can only trade options on SPX, but those option contracts are not priced to SPX. They're actually priced more to the futures, which are then adjusted for dividends and interest. And so that's why there's a disparity in pricing, because the futures contracts have to be adjusted for the fact that it's going to collect dividends and interest over time. And that's why it literally trades at a little bit of a discount to SPX. Now, most people think that you can exercise SPX early, potentially, and force some sort of arbitrage opportunity to force an early exercise of SPX and buy E-mini futures, but it's not the case because SPX contracts are European style contracts, which means that you can trade the contracts before expiration, but you can't actually force the exercise of SPX early. Only at expiration can you exercise your contracts in SPX. So that's why most people think there's probably an arbitrage opportunity to be gained here, but it's really not, because you can't really do it on a synthetic basis with the option contracts, since they be already factoring in the fact that the futures prices are adjusted for dividends and interest. So hopefully this helps out. As always, if you have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.